So for this next in the subscriber question in our series, this one is about the 20% pass-through deduction that was part of the Jobs Act that actually goes into effect this tax filing year. So I'm going to answer the question at least as I know it, but I want to be clear. I'm not a tax accountant. I'm not certified. I haven't actually done my taxes yet, so I don't see how it comes through. So all of this is just one guy's opinion. It's not meant as advice or do this or do that. But I was asked a question, and as always, I thought I'd just give my opinion. So first off, the 20% deduction or pass-through deduction is something that is available, near as I can tell, and actually verified with an accountant to real estate investors, right? There was early on a question of, is real estate investing a business or trade, right? Because the 20% pass-through deduction is meant for specified services, business or trade. So I actually asked two different accountants. I spent some time online and verified that real estate and investing and investing management are a part of that, and real estate should fall under the investing umbrella. So we do qualify. The pass-through deduction is a replacement for some standard deductions, as I'm being told, to hopefully simplify tax filing. The other thing to realize is there are some caps involved. So if you're filing jointly, what I'm told is the cap is $315K, and if you're filing as an individual, it's $157,500, right? So half of 315. Why is this important? Because what they're trying to do is, let's say, for example, if you made $100,000, pass through income, right, from your, from your LLC, for example, you could just take off the top $20,000, right? It's just that simple. So if your business made 100 grand, you'd only be taxed on $80,000, right? So 20% of 100 grand is 20,000. 20,000 minus 100,000 is 80, and that's what you'll be taxed on. It's pretty exciting. Again, the caps come into play. So if you start making above the thresholds, there is a phase out period, and then there's a cap even above that, which I don't recall, that where you don't get the 20%. So it's pretty interesting. The other thing I realized is, we generally call this the 20% pass-through deduction. The IRS is going to call it the 199A deduction. I'm guessing that's the form that's going to be coming, is a 199A. So that's what I know about deduction. It can be a sole proprietorship. So if you own all the assets in your name, you can still do that. Real estate investing, owning rental properties is considered a specified service or business or trade. There are thresholds. I will be looking to see if I qualify. Our income may be too high, but we'll see what we get done in December versus 1st of January. So maybe we'll come in under the umbrella. I don't know, but these are the things to realize. Right? I think the 20% pass-through deduction is, in general, a very good thing. I think it will, assuming it stays in its current form, be a good thing for years to come. So that's what I know about it. Again, make sure you talk to your accountant. Make sure you qualify, ask the right questions. But if you are in real estate investing and your accountant doesn't talk about it, either A, ask a question, or B, get a new accountant. Because near as I can tell, again, verifying this with a couple of other accountants, it does qualify. You as a landlord or owning rental properties is a qualifying business or trade, so you should look into that. So thanks for the questions. As always, this series is 100% subscriber based, so please subscribe and feel free to ask some questions. Have a great day.